Hi, I'm Gary from Westwood Estate Planning. Now, are you thinking about gifting money or property to your family but worried about inheritance tax? Perhaps you've heard about this 7-year rule and it sounds confusing, making you hesitant to act. Well, in this video, I'm going to explain exactly how the inheritance tax 7-year rule works, what gifts are covered, and how you can make gifts wisely to help reduce your inheritance tax bill. By the end, you'll have a clear understanding of this crucial rule and how it fits into your estate planning. Now let's get straight to it. Inheritance tax, or IHT, is a tax on your estate. Now that's your money, your property, and your possessions when you pass away. The standard nil rate band has been £325,000 per person since 2009, and it's frozen at this level until at least 2030. And the residence nil rate band can add an extra £175,000 if you leave your home to direct descendants. Anything above your available allowances is generally taxed at 40%. Now, the 7-year rule comes into play when you make gifts during your lifetime. In simple terms, if you make a gift and then live another 7 years, that gift is completely exempt from inheritance tax. Hooray. Now, if you pass away within 7 years, that gift might still be counted as part of your estate for tax purposes. This rule exists to prevent people from giving away all of their assets on their deathbed just to avoid paying IHT. So most gifts you make to individuals are called potentially exempt transfer, or PETs for short. As long as you live for 7 years after making a PET, it becomes fully exempt from IHT. But what if you don't make it 7 years? This is where taper relief comes in, though it only applies if your total gifts exceed the £325,000 nil rate band. If your gifts are within that threshold, there's no tax to pay anyway. So taper relief doesn't come into play. However, if you've made gifts totaling more than £325,000 when you pass away within 7 years, here is how taper relief works. So it reduces the amount of tax payable on the gift over time. So there's going to be quite a few figures now. But if you die within the first 3 years of the gift, the full 40% IHT rate applies to the amount above your allowances. Between 3 and 4 years, you pay 80% of the tax. That works out about 32% of the gift value instead of that 40%. Between 4 and 5 years, you pay 60% of the tax. So that's 24% of the gift value. Between 5 and 6 years, you pay 40% of the tax. That's 16% of the gift value. And between 6 and 7 years, you pay 20% of the tax. That's 8% of the gift value. And of course, after that magical 7 years, it's 0%. It's a sliding scale designed to encourage earlier planning. The key understanding here is that the clock starts ticking from the date you make the gift. And here's something crucial that catches many people by surprise. If IHT becomes due on a gift you made, it's usually the person who received the gift who must pay the tax, not your estate. Your estate pays IHT on the estate you still owned when you died, but gifts have their own tax liability that falls on the recipient. So the 7-year rule applies to those larger gifts, but there are several valuable exemptions you can use immediately every year without worrying about the 7-year clock. So firstly, the annual exemption. You can give away up to £3,000 each tax year completely free of IHT. And if you didn't use last year's allowance, you can carry it forwards 1 year only, effectively allowing you to give up to £6,000. But remember, you can't accumulate multiple years. It just carries forward that 1 year. So the small gift exemption. So you can give away up to £250 to as many people as you like in a tax year, but you can't combine this with any of the other exemptions, the same person in the same year. So gifts from surplus income. This is a powerful, often overlooked exemption. If you can demonstrate that you're making regular gifts from surplus income after tax, meaning you have enough income to maintain your usual standard of living without dipping into capital, these gifts can be immediately IHT exempt with no 7-year waiting period, regardless of their size. So this is particularly useful for things like contributing to grandchildren's school fees or regular payments to family members. However, this requires careful record keeping to prove to HMRC, and it's typically claimed by your executors after death using IHT 403 form. I recommend keeping detailed records of your income and expenditure if you're planning on using this exemption. So wedding gifts. You can give tax-free gifts for weddings or civil partnerships. So £5,000 to a child, £2,500 to a grandchild or great-grandchild, and £1,000 to anyone else. These gifts must be made shortly before or on the day of the wedding and conditional on the ceremony taking place. Gifts to spouses or civil partners. Now, any gifts between spouses or civil partners who are both long-term UK residents are completely exempt from IHT. From April 2025, the rules changed from being domicile-based to residence-based, but the principle remains the same. You can give unlimited amounts to your spouse or civil partner tax-free. Now, using these exemptions strategically can significantly reduce the value of your estate over time. So, while understanding the 7-year rule and these exemptions is a fantastic start, there are some important pitfalls to avoid. One crucial warning: you give away an asset, but to continue to benefit from it, for example, giving your house to children, but continuing to live there rent-free, this is called a gift with reservation of benefit, or a GROP. These gifts don't qualify for the 7-year rule, but will be still counted as part of your estate for IHT purposes. To avoid this, you'd need to pay market rent to the new owners, or of course, move out completely. So IHT planning can be complex, and there are other strategies like using trusts or life insurance policies that can also play a vital role in protecting your wealth for future generations. So the real goal isn't just to avoid tax, it's to ensure your wishes are met, your family is provided for, and the process is as smooth and as stress-free as possible. Making mistakes with gifts or IHT planning can lead to unexpected tax bills and complications for your loved ones, particularly if the residents end up with an IHT liability that they weren't expecting. That's where expert guidance comes in, helping you navigate the rules, avoid common pitfalls, and create a robust plan tailored to your specific circumstances. If you're considering making gifts or want to explore how to effectively plan for inheritance tax to protect your family's future, click the link in the description box below to book your free 15-minute, no obligation chat with myself. It's an opportunity to gain plain answers and understanding on how to make your estate planning work for you and your loved ones. So thank you so much for your time while watching this video. I'm Gary from Westwood Estate Planning, helping you protect your future and your loved ones. So I hope to see you on the next video, and bye for now.